Welcome to this episode of Crashes and Taxes. I am your host, Rebecca Walser. Super excited to be with you. And today we are going to talk all things tax. We are specifically going to talk about the capital gains tax and what this administration has specifically promulgated recently here regarding capital gains. Now, this is going to get a little bit convoluted, so I'm going to talk to you first about what we have just been analyzing with this administration, and then I'm going to talk to you about what was explained when he was running and now where we actually are. So really kind of what we were told, where we are, and what we see as actually happening. So it might get a little convoluted, but I will do my absolute best to make it as clear as possible before this podcast is over. So the first thing I want to say is we are going to talk about the proposed tax plans by this administration, and I am ardently, I am adamantly, absolutely a pro-growth tax lawyer and wealth advisor. So anything that is discriminatory against investors or capital investment is something that I clearly am against always. Because as a tax lawyer, I can tell you that tax absolutely impacts people's decisions, where they put their money, how they invest their money, the duration of the investment. All of this does absolutely look at and to some extent incorporate into and depend upon tax policy. So we know this, and the government knows this because the government incentivizes certain behavior through the tax system, and we know this as well. So for us or for any experts to act like, and I've seen the New York Times, I've seen other media outlets talk about how this capital gains tax is literally going to have little to no effect, and I completely disagree. So there are a couple of things that are happening that are going to start to make investment in the United States, and specifically GDP growth, more challenging for the United States. So at the corporate level, we already see that this administration is talking about changing the corporate tax that Trump cut to 21% back to 28%. Now, Secretary of Treasury Janet Yellen has specifically talked about how we do not want this to be a global race to the bottom. In other words, what she has acknowledged is that as the United States moves back to 28% corporate tax rate, that this will cause problems for corporations, and that corporations that have a fiduciary obligation to maximize shareholder price and value will look at opportunities for what we call tax arbitrage. Tax arbitrage means if you have an MNC, a multinational corporation that would otherwise, like Apple, be based in America because it is an American company, a US-based company that became global. You don't have Apple going to Ireland to basically domesticate in Ireland all of their non-US business, so that the United States does not get to charge the corporate income tax on all of their non-US business. Now, Ireland has its own tax case with Apple that is not something we're going to go into on this podcast, but the point is, if you are a multinational corporation, an MNC, and you know that you have a better tax rate in Ireland than the United States, then why would you have your global headquarters for all of your international revenue in America? You would outsource that corporation for the international sales outside of America and just pay tax on your American earnings. So this is what these companies do. They make sub-entities, subsidiaries internationally, and then they domesticate them in international countries where the tax rates are lower, and therefore we do not get that money back into America. So this is why Trump was able to repatriate trillions of dollars when he cut the rate from what it was to 21%. Now, Biden wanting to raise it back to 28, you already have Secretary Yellen basically saying that she has to go out and talk with other world leaders and say, let's not race to the bottom to a zero rate. You guys, let's all have the rate at 28% or higher, and that way there won't be options. The problem is Janet Yellen and this administration, we are not in charge of the world, and there will always be a country somewhere that wants to attract business and decides to do that through their corporate tax rate. So I don't see Janet Yellen and this administration being successful at getting the world to agree to a 28% corporate tax rate worldwide. And so that's going to be a problem. There was an actual CEO survey that was done regarding this 28% new increase to tax rate, and 95% of CEOs said that it will absolutely put them at a competitive disadvantage to be domestically based in the United States with a 28% rate. 75% of them said it would absolutely make them pull back on their R&D, and 71% said it would absolutely affect them and their hiring plans. So this is not necessarily the best time coming out of a global pandemic to institute this corporate tax law change. So specifically, Joe Biden is wanting and has already announced that he will increase the tax rate on capital gains taxes for those that earn over $1 million. So let's just step back for a moment and talk about what did they say they were going to do during the campaign. They said they were going to raise taxes in general, raise taxes on people that make households that make $400,000. In fact, they said people that made $400,000. So we thought really individually you had to be making $400,000 or you would not have an impact. They have since clarified that now, and they've said that households that are making $400,000. When you use the word household, remember we haven't seen the actual bill or law proposed yet, and we won't because we expect them to use the budget reconciliation process to try to pass this tax code change. And if they do use the budget reconciliation process, then they will not actually let us see anything until probably October. So what we're trying to ascertain is what the bill will actually look like. But when you start using the language before saying it was people that were making $400,000, and now once you're actually in office, you start saying, well, it's households that make $400,000. Then as a tax lawyer, we start thinking, well, that means people that are single or head of household or that are making $200,000 and up are also going to experience a tax law increase. So since we don't have the benefit of the actual proposed bill yet, we don't know. But I'm now basically assessing as a tax lawyer that if you're making $200,000 or more as a single or head of household, you should expect some sort of basic tax level increase. And then for the rest of people that are household-wise making $400,000 and up, you definitely expect a tax law increase. What we know is that he wants to raise the top tax bracket from 37 under Trump to 39.6, so just under 40%. And so that's kind of the area where we're expecting the actual ordinary income tax law changes based on everything that we've gathered and everything that's been communicated. Now, going to capital gains, we had an announcement by this administration that those earning $1 million or more will now have what we call an ordinary income tax rate. Or in other words, they will no longer have a capital gains favored rate. They will just pay the top tax rate of the ordinary income tax table, which we just said will be 39.6% plus the Obamacare surtax for net investment income, which is 3.8%, giving us a total long-term capital gain tax rate of 43.4% for people that do fall in that $1 million category. Now, I want you to understand something. The government does this all the time, where they have an intention to reduce a certain policy to apply to a lot more Americans. They start off with $1 million so that basically people don't complain, don't get upset and don't say, oh my gosh, this is going to apply to me. Most Americans ignore it because it doesn't apply to those households making $1 million or more. So most Americans ignore it. Then it becomes law, and then as it becomes law, they abruptly, as we've seen, will bring that $1 million down to a much lower threshold. So we're starting to look at the elimination of capital gains for people that are high income or high net worth people. And I think this is a problem because it absolutely does penalize people that make a lot and that use and take their earnings and invest them into our economy. And investments basically is what grows and determines our GDP. If we're not investing money into companies, if companies can't actually grow their research and development budget because they're taxed at a 28% rate when they could be elsewhere taxed at, much less, or if they can't hire, or if they can't do these things because increases of corporate tax rates are going up, But also, if American investors are not wanting to invest here in America because they know that their capital gains rate is basically almost 50%, 43.4%, then that is going to change their behavior. And absolutely, people that are making $1 million a year have means to look for alternative investment routes, routes that don't necessarily generate or aren't maybe the best investment, but because of tax policy, you choose that investment instead. So this is a big problem, and it does lead people to take extreme measures. I mean, you probably will see some people that will become expats and they will renounce their citizenship, because America is the only country in the world that if you are an American citizen, you are taxed on your global earnings, no matter where or how derived. In fact, as a tax lawyer, I can tell you that even if you're selling drugs or illegally gambling or running some kind of crime ring, you can actually go to jail for the rest of your life for not paying taxes on your illegal activities. Now you might say, well, that's dumb. I wouldn't report my illegal activities on an actual tax return. But you got to look at Al Capone. How did they get Al Capone? What did they get him on? Tax law violations, mail violations. So trust me when I tell you that tax law is not something that you want to mess with, because it can really bring down a lot of people. So there's a famous tax law case where a guy was a drug dealer, right? And he was literally in a lot of trouble because he didn't report his earnings, even though they were illegal earnings. The government's position was he should have reported them and paid taxes on them, and then the criminal law division could deal with whatever else, but they were just the tax law enforcer. So that was a really great tax case. But what I'm trying to let you know is that people's behavior will change. And so let me just back up and explain now. So what we're looking at is, so far we've covered 3 different tax law changes. The corporate tax increase from 21 to 28%. The income tax for individual Americans going up for households that we now see as either a single or a household of 200,000 or more, and a married family of 400,000 or more. So we are going to have a change in the tax law ordinary income tax chart. We already know that. And then we're talking about specifically capital gains tax law changes that are changing for people that now they're saying make $1 million or more. Now, if we compare those 3 changes with what was pronounced during the actual campaign, the only thing that this administration said during the campaign that they are not actually implementing, I'm going to explain to you right now. So this administration, in addition to raising the capital gains tax for people that are earning active earnings of $1 million or more, the other thing they are doing is they are eliminating a provision called the 1014, or what we call the step up at death, the 1014 step up of basis to fair market value at death. So right now, you might have a trust, and you might have your house in your trust, and you have the right in this revocable trust to stay in your house for the rest of your life, but the trust owns the house, and the trust distributes the house to your children automatically at your death. Let's just say that that's just your standard trust language. Well, normally when you own a house in a trust, let's say that the house, let's say you bought it for, $200,000, and 20 years later it's worth $1 million. Okay, so your basis is 200,000 plus any improvements that you put in over the last 20 years. Your basis is 200, and you sell it for $1 million. Now, if you're not selling it, right, you're just going to leave it in the trust and it's going to get stuffed up. Normally what happens is when you pass away, your children will inherit that house at its $1 million value through the trust, because 1014 step up at death kicks in and increases the basis of that inherited asset inside of the trust to its full fair market value. That is what we call the 1014 step up at death. That is being eliminated. This is one of the biggest tax law changes in the estate planning world that we have had since 2010's big change with portability. This is huge. We have so many trusts in this country that are counting on the 1014 step up at death. So this is a huge problem. So the first thing they say they want to do is eliminate the 1014 step up at death. So now you've got all of this stuff that was inherited, normally stocks, real estate, everything that's inherited at this fair market value at death, that is no longer the case. Now you're going to have to carry over the basis. So what that means is the trust will get the house at 200,000. If the kids go to sell the house for $1 million and split the proceeds, they are going to have to pay tax on that gain of $100,000. So that is a huge difference. So the first thing is we're eliminating the 1014 step up at death. The second thing is we're raising the capital gains tax for people that are making X amount or more. The third thing is we're raising tax rates on people that are making, like we said, $200,000 or more. The fourth thing that this administration wanted to do was to lower the estate exemption from $11.7 million in 2021 to $4 million. And because they are eliminating the step up at death, and because they're also increasing capital gains tax rates, they decided to postpone the reduction of the estate tax, because it was just going to go over like a lead balloon to the entire estate planning law community and tax law community. So this is what has happened, and we are expecting to see a substantial amount of changes as a result of this tax code getting implemented. And we are starting to expect to see a lot of behavioral modifications of high income and high net worth investors, because they are not going to just stand by and say, fine, everything is just going to get taxed at this massive percentage. That's fine. I should just tell you that my professional opinion is within the next 10 years, the estate tax will be lowered to a limit somewhere in the 2 to 3 million per person range. That is what I'm expecting. And then I expect the estate tax to be somewhere in the neighborhood of 60% plus. And this is all happening because of the retirement of the baby boomers that is really happening in mass these next 7 years through 2028. We have about 65 million people we expect to retire. So I summarize this by sharing with you that we have a lot of changes coming with this administration. This administration is quite hostile to investment and corporations. This is nothing surprising. We knew this would be the case. But these foundational tax policy and estate policy changes are going to create huge ripples in the market, going to change how we have to plan around estate taxes and income taxes. And it's going to be quite a significant event. As I mentioned earlier, 95% of CEOs said that the corporate tax rate will make them less competitive. 75% said that it will make them reduce research and development investment, and 71% said it would definitely affect their employment and their hiring new employees in the recent anytime soon coming out of this pandemic. So this is it. This is all that I wanted to share with you of why the market had a negative reaction. You've got a lot of media outlets like the New York Times trying to say this is not going to have that big of an impact, and that is completely false. That is people that want to have their narration. This country believes at its core that people that have wealth and make a lot of income deserve to pay higher taxes than everybody else. And I'm not saying that I disagree with that, but what I am saying is that there are not enough rich people in the world to support free healthcare, free housing, free education for 90% of the population, 80% of the population, 70% of the population. We don't have enough rich people to just tax the rich and provide all of these benefits for everybody else, especially if the borders open and we have people coming in from the South. That is another issue. So until next time, you guys, I hope this was very clear about how the tax law policies are changing, and I look forward to speaking with you again.